Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host, and I'm joined with my good friend Doug Heagren. Hey, Doug.
Good morning, Kirk. How are you today?
Doing great. Doing
Hey,
great.
listen,
You're blurry again. I
of
hate to
course
keep
I am.
coming up with these old jokes.
You know what I'm going to do? Why don't we just start changing this to a call-in show, and I'm just going to dial in because the video is never the video is never doing what I want it to do. I've got a new camera ordered. Listen, if I can make a word of advice to anybody out there looking to get tech, if it says autofocus on it and doesn't have a manual focus, which of course none of them do these days, pass on it. If there's needs, this is the listen. It's a great segue for what we're going to talk about. Digital, right, Kirk? It's like this day and age, we're trying to automate and digitize everything with this fake processing crap. And listen, sometimes it's nice to just be able to go back, find a little dial on it, do a little bit of adjustment, and outsmart the stupid tech. And unfortunately, as much as we're talking about AI and as much as we're talking about the development of how intelligence is going to exponentially fast forward into the future with technology, it is one microcosm of an example of how we can't let tech get too far ahead of us and lose control of it, because sometimes an adult has to step into the room and fix it. But they're taking all that away from us. There's nothing I can do on this camera. I'm trying to adjust it. Nothing. So
Well, as you can tell, this is going to be a great show because Doug is already spicy and we haven't even started yet.
that makes for great shows.
All I can tell you, Doug, is I wish we were swapping because I got this weird thing in my eye that happened when we came back from our trip, and it's this weird thing that's going away, but it was worse. So I wish I was blurry and you weren't today.
Actually, let me rephrase this. I don't know what you're seeing, Kirk. My picture is perfectly clear. It must be that thing in your eye seeing me blurry. And for the rest of you out there watching this, wherever you may be, you might want to get checked for an eye infection too. It is not. My picture is coming in completely clear. The problem is you. No, just kidding.
All right. Well, before we gross out our entire audience, let's get into the charts. All right. So let's get in. Let's see. So I'm going to share this chart because Doug was just talking about this with tech. So here's a fun chart today. FAANGMNT. We're gonna have to come up with some new word for that. I'm surprised with the two vowels in there, you can't come up with some word. Anyway, so FANG plus MNT, which basically big tech, for those of you who don't know what that is. I don't even know what it encompasses now. It's NVIDIA, Microsoft, Google, Netflix, Apple, Amazon, Facebook, which is now
I think it stands for Mass New World Order Technology. Or no, wait. I mean, the W
plus
and O aren't in
Tesla.
there. Yeah,
Yeah.
right.
So it's basically the point is it makes up 25.4% of the S&P 500's market cap. So a total of 8 stocks out of 500 make up a quarter of the S&P 500's market cap. So if you take all of the 500 stocks and put them all together, the market cap equals, let's say, 100. Those 8 stocks make up 25 of that 100. That's crazy. And by the way, this year's year-to-date returns on the S&P 500, 82% of those returns come from that 25%. Okay, that's a whole lot of crazy. That's all I'm going to tell you. So really, what it comes down to is it's not whether it's good or bad, right? Obviously, it's done really well this year. In the face of, if you look at these individually, you'll see they've actually performed fairly well. But the point is if you're looking at it in the grand scope of things, just understand that most of the returns this year have come off of tech. And to put a finer point on it, tech did really horrible last year. And so as of December 31st, tech didn't do that well. And you look at the NASDAQ for performance to give you some example of that. But in January, tech did really well, as you can see, and got a lot of the returns that came from that period. Now, Doug was talking about this earlier, and I want to move into another slide before we jump off into Doug, is if you look at these returns from tech stocks, here's another one that I will point out, which is basically just Apple. And I'm not supporting Apple or thinking it's good or bad, but just to point out, this is a chart back in the last, 40 years, 43 years. And it looks at the largest companies, the largest weighting of holdings in the S&P 500. So back in the 80s, IBM was 6.4%. So one company was 6.4% of the whole index. If you look at the late 90s, Microsoft was 4.9, ExxonMobil was 5 in right around 2008, and then the last few years, Apple was 7.1. So here's one single company that makes up 7.1% of the S&P 500 index. Now, I think that's a bit of a problem. If the idea is to invest in an index, now basically the problem is what everybody wants is return. They don't care about what it's doing overall. They just want positive performance. So there's this incentive for everyone to get positive performance. And part of the problem with the S&P 500 is it's market cap weighted. Now, you could look at the math, you can talk to all the quants, and they'll tell you, well, equal weighting is better because you don't have one company or a handful of companies dictating the performance of the index. Well, the problem is people think that's great if it's not performing. They say, well, it should be equal weighted, like last year. You wouldn't have lost as much as if it's equal weighted. Yeah, but in good years, it's going to outperform, and people want, in good years, they want this, and in bad years, they want the equal weight. And you can't really have your cake and eat it too. I only bring this up just to point out the lopsidedness of the index nowadays and what that means for investors. Now, Doug, you were talking about before the show, you're getting your panties in a bunch a little bit about the investor sentiment in tech. So I don't know if you want to dive into that a little bit. We can bring up some of these charts.
Hey, now, Kirk, can't say that these days, but no,
yeah. I didn't ask Doug. I'm just saying.
so here's what I was getting into, and we saw this a couple years ago that and we've been talking about this for quite some time. The biggest movement of the S&P 500 is attributed to the returns of the S&P 500 are heavily attributed to the biggest movers in the S&P 500. And that has been tech for many, many, many years, which, we've talked about, are you diversified? Oh, hold the index. The index is going to be fine. Well, what is the S&P 500? Are you diversified? No, not really. Because again, if you break it down, so much of that is driven to one asset class. And the other thing too is that if we go back to the profitability, we said this a couple weeks ago, Kirk, you might have the chart on there, but the change of the price to earnings in technology from a few years back to present is astronomical. I mean, it used to be, single digit price to earnings that have now jumped to the mid 20s. That's a significant erosion of profit based on what you're paying for that stock. And we go back and look at this list here on this chart that that Kirk has up, and you see that of the FAANGMNTs, I mean, look, it's the who's who of the same companies that have been on these lists forever. The only one that's interesting is NVIDIA, because all of a sudden with AI and GBT, all of a sudden NVIDIA is exciting again. But hey, Kirk, you may remember this 12 months, 24 months ago, all of a sudden NVIDIA couldn't do anything right, correct? So yep. What is that telling you? Is NVIDIA a better company today than it was 2 years ago? No, it's just popular. Like all of a sudden, it's like AI got exciting again. And that is the problem that we're running into, is that people are investing based on excitement. They're not investing based on fundamentals. And I think there's room for both. That's why we call them growth stocks. There's a room for both opportunities there. But I think that unfortunately, generally speaking, the majority of investing that is happening is based off of speculative output. And again, the fact that these companies are known, everybody uses them, they're taken over. But the problem is that there's a tremendous number of companies out there that are truly consistent. We call them boring companies that are out there producing massive revenue, and their stock price is going nowhere. Kirk does one of the other things that we do is a podcast panel for some different speakers that Kirk talks to weekly. And several weeks ago, one of the individuals that Kirk was talking to mentioned, and Kirk I can't remember who said it was, you, Kirk, or the other individual, but they were talking about how interestingly it was that if one of the first questions that kind of came up, whether or not venture capital was going to invest in that company, was its profitability. And it was actually a negative indicator. If the company was profitable, the VC wanted nothing to do with it, which, I mean, let's face it. I mean, if you really are thinking this world's being driven by some incredible business minds, The VC world just proved everything that they're trying to lead you to believe was wrong. If what you thought you knew was true about VCs being smart turned out to be untrue, when would you want to know? Let's buy companies that don't make any money and then cross our fingers, because then we're going to, get this wonderful growth and, compounding return. Well, eventually, if things don't have real, tangible financial success, that compounding return will come crashing to the ground. Now, when that's going to happen, don't know. Uber's still around. I don't think it's ever made a profit. I think it still hemorrhages money left and right. It is still here today. Carvana, well, I mean, their stock price did finally come crash to the ground, but guess what's been rolling back lately? If we look at this list here, other than NVIDIA, and I can't see the whole list on the charts, but there was a publishing a couple years ago that talked about what the average holdings of millennials was, just to pick that's what this group was. Not picking on millennials this time, but what they were looking at is basically out of 10 top holdings, the only holding that wasn't completely in line with this list, besides NVIDIA, because it was kind of on and off, was Berkshire Hathaway. Because Buffett has created this celebrity establishment of being this great investor, the smart mind, but that 9 other holdings were Facebook, Apple, Netflix, Google, Microsoft, you name it, Tesla. And so guess what? The irony of that is that if you are investing in Berkshire Hathaway because you think Warren Buffett might have a little bit of experience in understanding how to pick quality companies, which again, even his returns are not quite the same as they were today as what he was getting in his early career in the 70s and such. But if you believe in what he's doing, none of these companies, other than Apple, I think is one of the ones he has a pretty decent holding on, maybe Microsoft, but I haven't looked at his list recently, but none of these holdings are actually indicative of anything he holds. So it's kind of this counterintuitive investment strategy of all of these speculative, in many cases, either so big that the growth is now fairly diminished. I mean, Apple keeps putting the same phone out 47 different ways at this point. It's not where it was 10 years ago. Microsoft is actually one that's exciting to me because it has just the sustainability of Microsoft since the late 70s is incredible. But other than that, if you look at what Warren Buffett holds, this is not his portfolio. He likes predictable, boring companies with profits. Unfortunately, Kirk, the stock market seems to be just enamored, almost like, I'm going to go there, Kirk, a heroin addiction to things that are really, really exciting and unfortunately really, really homogenous, really one type of thing. And I'm not sure that, again, it may continue to grow because as long as there's passion, excitement to drive the stock market, we've talked about this in several weeks, the stock market is driven a lot by emotion. And as long as there's a lot of people that emotionally continue to believe it's going to be the great place to be, then, hey, again, your money may be safe for quite some time in these holdings. The question is, you don't know when the tide will turn and when profit's going to matter.
This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money.
Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today.
Yeah, so I want to dive in here and show there's a bunch of things I want to get to this week, and I want to get to, let's see. All right, so first one, this is the chart of the S&P 500 index, and this is for the past few years. And I point this out, you can see obviously where COVID happened, right around here, and then you can see the run up, and then we see it came down. And I point this out for a few reasons. One is that to show that, I mean, the high prior to COVID was 3,400 on the S&P 500 index. Right now, it's a little shy of 4,200. That's a big jump, and we were we were expensive prior to COVID. Okay, and now it's, even though it's come down, everyone freaked out. They freaked out because they looked at the high watermark and said, "Oh my God, I lost money from the top." It's like going to the casino and winning $1 million and then giving back 200 grand because you didn't know when to stop. It's like, oh my God, I lost 20%. No, you made $800,000. But we as human beings, we look at the high watermark and say, oh, I lost from the peak. It's like, yeah, but you still made a lot of money. And I think we kind of forget the fact that, you know, that there was a huge run up based on a lot of factors, one of which was an enormous amount of liquidity put in the system and a whole bunch of other factors. And now that's kind of coming off because the Fed's balance sheet is running off. Even though the bailout of the banks a few weeks ago kind of boosted it up again, it'll probably take a little while to come down, but it's going to start to come down. But I put this chart for one specific reason, okay? And this is, you could look at this chart and say, well, it's bullish. And you could also look at this chart and say it's bearish. And I think what's important to note, and the reason I want to point this out is because we don't know. Right? No one knows whether it's bullish or bearish. It is within a range. It is the red line that's going through that is what we call a 200-day moving average. It is what is looked at by technicians as a sign of, is the market in a bullish trend or a bearish trend? If it's above, it's bullish. If it's below, it's bearish. Historically, that's how the markets have looked at that. Doesn't mean it's 100% accurate. Absolutely not. But the point is if it's above, generally speaking, most people look at that as bullish. If it's below, people generally look at it as bearish. But I would look at it and say, right now, it's obviously within a range. It's bounced around a lot, and it's still within this range. So even though it's at the high end of the range, it doesn't mean it's going to keep going up. It just means it's still within the range. Now, I wanted to start with that, and I also wanted to get to earnings, right? So in the next, I don't know, mostly this week, but also next week, is earnings season. 87% of the S&P 500 equity or market cap will be reported by May 5th. So 87% of the S&P 500 will be reported by May 5th. That's a lot, right? This week, 42% of the S&P 500 is going to report this week. That's a ton of companies. Now, obviously, there'll be some in the future, but most of it is this week and next. Now, what does that mean? Well, some people are going to look at that and say, oh my God, it means that if earnings are bad, the market's going to crash. Or if earnings are good, the market's going to skyrocket. I'll tell you what it really means. It doesn't mean anything, right? So the market is what it is, right? And it's silly to say that, but either the earnings are going to be good or bad, right? But the market has already priced in earnings. The only thing that is going to matter in the next 2 weeks are surprises. Because basically what happens on Wall Street, and this is kind of a secret behind the scenes kind of thing that most people won't tell you, but basically the way Wall Street works is like this. Let's say you have the CEO of Acme Company, and just make up a company, right? Wile E. Coyote is the CEO, right? So Acme Company, they have earnings coming out. Well, the analysts want to know what the earnings are going to be like, right? Because they want to do a good job for their people, right? They're selling research to people and they want to be accurate. So they talk to CEO, they talk to CFO, they interview the channels, the sales channels, and they kind of figure out, all right, my best guess is this is what I think this company is going to do. Well, also behind the scenes, they're getting their whisper numbers. They're talking to the CFO, and the CFO is like, and the analyst is probably like, hey, are you going to make 5 cents or 6 cents this quarter? and maybe the CFO says something, maybe they don't, right? They're not supposed to, but it kind of does happen. And even if they don't say anything, there's always this like wink, wink, nod, nod of we're going to get you within the ballpark. Is it going to be 20? Probably not. Is it going to be negative 20? Probably not. So they'll be close, right? And it's not necessarily them disclosing information, but it's more of like, here is some information you might want to look at. You figure it out for yourself. And all these people are really smart. They can figure it out. So what ends up happening is the analysts on Wall Street end up being very accurate for what the number is going to be. So there's a expected number, right? There's a number they expect. So Acme Company, the street expects 5 cents a share. That's what they expect for earnings. Now, if it comes out and it's negative 5 cents, well, the stock's going to drop a lot because obviously the analyst got it wrong, or the company didn't disclose certain things, or they're surprised, or whatever it is. There was a surprise. A negative surprise means that the stock is not accurately priced. Because remember, in prior episodes, we talked about this. Stocks are priced in anticipation of what's going to happen 6 months from now. So 6 months from now, they expect the stock to go up X percent. So it's already up X percent in expectation. So if the earnings come out and it's negative, well, they didn't account for that. That means the stock should be lower. So stock's going to drop whatever, 5, 10, 15%, whatever it needs to be, to come in line with that future expectation of 6 months. So what matters to the street is the earnings number, and more importantly, what are the expectations that the executives are going to communicate to the analyst community. So if they come out and say, yeah, we missed by 5 cents because Joey slipped and fell and there was a lawsuit that cost us $1 billion. Well, that's a one-time event. Analysts are going to be like, yeah, whatever, we don't care about that, right? They're going to look at it and say, the company's still sound, the earnings are still sound. So what it really means is, the stock price probably isn't going to move all that much. However, if they come out and say, you know what, things are looking great, and then all this high inflation happened, it's really starting to impact our bottom line. Now the street's going to look at that and say, all right, the stock is too expensive. We need to drop our estimates, which is going to drop the price and expectation of that. So the price movements are based along future expectations of earnings and of growth and whatever needs to be. So effectively, as long as these companies report in line with expectations, there'll be a whole lot of nothing. There'll be a big nothing burger in the next 2 weeks in Wall Street because nothing happened. But if the earnings are surprises, then you might see a lot more volatility. So if you're watching CNBC, the Wall Street Journal, all these things are like, oh, it's going to be a crazy season. The earnings are going to be great. They're going to be terrible. Doesn't matter. What matters is, are there going to be surprises? That's the only thing that matters to determine the direction of the markets. Surprises on the upside, market's going to skyrocket. Surprises on the downside, the market's going to tank. That's what you should be looking for with earnings season. That's the only thing you should be looking for. Anything else is irrelevant. And if earnings, and this is a tell, if earnings come out and the stock price doesn't move more than 1% or something like that, then everything was priced in according to expectations. It doesn't matter if they blew out earnings. If they said, oh, we were up 20% this quarter, it doesn't matter because the street already priced that in if the stock market doesn't change. One more thing to take into account for. Now, if you're buying a dog, some company, I'm not going to name it, but let's say I go there to put up my pictures and communicate with friends and maybe buy some ads on it. One of those companies, I'm not going to say the name, but a company like that.
Is that a newspaper, Kirk?
No, it is not a newspaper. It's digital. I can tell by the look in your face, Doug. It is digital. Anyway, bad joke. So this company, if they come out with bad earnings and the stock price doesn't drop, what that typically means is that this is probably a good time to buy. Because if a company comes out with terrible earnings and they're like, oh, it's terrible and the things are going to get worse and the stock price doesn't drop, what that means is the street has already priced in all of the bad news. And what usually that means is if bad earnings, bad future expectations come out and the stock price doesn't drop or drop that much, what it means is it's probably a good time to buy. Because everyone's already thrown out the baby with the bathwater. They're like, I've given up on the stock. I don't care about it. Everyone's gone. That's the time to start looking to buy. Conversely, if a stock comes out with crazy good earnings and doesn't go up all that much, it's probably a good time to sell. just based on the fact that the street has already priced in crazy good earnings and things can't get any better, this is probably a good time to sell. So think of that angle when you're looking at individual stocks, because things are going to get volatile. There's going to be good and bad earnings coming out. All this volatility is good for some companies, bad for others. But what you should know is that that is a sign that it's probably a good time to start looking at a company. And I'm not even talking about the fundamentals. I'm just talking about sentiment. And I want to share one more slide here about sentiment before we get to Doug again, and then we're going to get into some other topics because we had a lot to cover today, and I want to make sure we cover it all. So this is the NAAIM. Okay, this is the basically investor sentiment. I'm not going to get into details on this, but basically it's investor sentiment. So what this shows is investor sentiment good or is it bad? Do investors think that, hey, it's a great time to buy, or is it terrible and they think it's a great time to sell? Now, what you might notice here is investor sentiment tends to bottom at the lows in the market. So look, March, April of 2020, that was pretty much 10 on the scale. The highest point is like, I don't know, 113 or something like that. And the low is 10. Okay, October of last year was right around 12. Right now it's about 78. Okay. What is it? Close. Yeah, 78. So if you think about it, like we've hit a low last year, it dropped a lot. It dropped pretty much from November of 2021 and pretty much dropped until October of 22. So that was a sign. People think, oh, the bottom's in. It's all over. Now this doesn't go back any further, and I want to point out this is not a historical context. This is only in the scope of the last few years. If you look at it historically, it's going to show you something very different. But what I wanted to show is investor sentiment is picking up. I'm hearing a lot of, hey, things are bullish again. People should get back into the market. We're on a tear. The markets are screaming higher. Are they? I don't know. I'm not seeing them scream higher. I'm seeing them go sideways. But that's the sentiment. And I point this out because it's really important that people understand the sentiment. The sentiment is important. If the sentiment is on one side of the fence, you probably want to get in the other side of the fence or the boat. You think that if all the investors are on one side of the boat, it'll capsize. You want to be in the other side of the boat. That is historically what you want to look at is investor sentiment. Is this a good time or bad time to invest? Right here, we're in the messy middle. It's not a good or bad time, but it does show that investor sentiment is picking up, which means the stock prices may start climbing because of the sentiment. So that's really what I want to point out here is that sentiment matters, because especially if you're investing in growth stocks or momentum stocks, investor sentiment is really important because that's what drives those stocks. There's no momentum, there's no growth in a utility stock. That's a boring, dull company that's going to pay you 5% dividend a year. No one cares, right? No one's interested. It's not sexy. It's not great. It's going to crank out that 5% dividend every year, and you can count on it. There's the investor sentiment, although it does apply, you're not going to find it there. You are going to find it in growth stocks, though. So it's important to see that. Now, I want to point out another factor here, which is the VIX or volatility. Now, I point this out because now most of you, this is technical and you're going to go to sleep on this, but I'm just going to point it out at a high level. Right now, the VIX, which measures volatility. So if you'll notice, the volatility in 2000 and where is it? It barely shows it. It doesn't really show the volatility. But if you look historically, 2020 volatility was as high as it's ever been. I think it hit 80 at the VIX. Right now we're at 16. And if you're in the low 20s, if you're below the 20s, it means that all is well and that there's no risk and there's no volatility, there's no fear. But when it goes up above 20 or 22, that's when things start getting a little crazy. Now, if you notice in March, that's when we had SVB, when you had Signature Bank, when you had those banking issues, the VIX spiked almost instantly because people were fearful that this might turn into another 2008. Will it? I don't know. It's still too early to tell. But apparently the market doesn't think so. The market is all good, right? They're going to sleep soundly. No one's staying up at night. And if you reflect back in 2021, it's the same thing. Oh, everything was great until it wasn't. So I point this out because not because of where we are, because I think that's important because it is dropping. I mean, 16 is a really low number. But I point it out because what I'm hearing with a lot of people in Wall Street is they're actually curious if this is accurate. Is most people are questioning this, saying, is this even accurate? Because they're not seeing what this is showing. What they're seeing is grave danger ahead. And this is showing all's clear. There's no waves, there's no storms ahead. Now, I want to point something out to illustrate the point. Now, we have once again a debt ceiling coming up in the next, I don't know, next quarter or so, next few months. We have the debt ceiling approaching, and we've been through this before, haven't we, Doug? Haven't we seen the debt ceiling before?
Unfortunately, I don't think we saw the debt ceiling probably any time before my life. And since I graduated college, what have we seen this like a dozen times now? It seems to be the new norm.
Yeah, every few years we have this debt ceiling problem. And all it is it's a chance for politicians to stand up on their high horse and show how important they are. Oh, look at us. We're really important. We're fighting over something that shouldn't really even matter and we shouldn't be fighting over. But we've chosen to fight over the future of our country with politics, and only to make ourselves look good. They could easily solve this problem, but they're going to decide not to because why the hell not? No one else is going to suffer. Oh, wait, yeah, everybody but them will suffer. So I point this out because this is not the first time it's happened. It's not going to be the last time it happened. However, this time it appears that the markets are a little squirrely. Now, if you look at this goes back to 2008, and here's what it's showing. This is the 5-year sovereign mean country CDS pricing, credit default swaps. Remember what those are? Oh yeah, remember that the movie The Big Short? Remember 2008? Well, credit default swaps were basically created to insure against the risk of default. Now, the problem with a credit default swap is if you really are defaulting and things do get ugly enough, who's going to be around to pay you? Which was effectively the problem during 2008. And this is where, Michael Burry famously betted against the banks and made lots of money. But at some point in time, there's a question of whether you can actually get paid out. So the point here is, if you look at this in 2008, they spiked way up. And what was worse than the US were developed markets. This is international markets. And so I point this out because what this is really showing is that while international markets are actually relatively low, the US is spiking. It's gone from a low of whatever it is, 10 up to probably right around 45, 50 right now, which means that people are betting against the US. They're betting that the US is going to default on its debt. That's not good, right? That's not good at all. What that shows to me is that the bond market, which are the smart people in the room, are betting against the US dollar. They're betting against US treasuries. And they're saying the US is going to default on their debt. Now, what's interesting is with this debt ceiling coming up, no one's under the illusion that it's going to go smoothly. Most likely it'll come up in a few months and they'll get pushed out until September. Usually September, October, November, this is usually right around the time where the big fight happens. Typically it happens around an election, but it's not an election year. So they're going to have this big fight and eventually they're going to figure it out. They're going to negotiate some settlement with the other side and they're going to figure it out. But in the interim, we're all going to be sitting on our hands. We're going to sit on pins and needles saying, oh my God, are we going to default? What's going to happen? The news is going to go crazy. They're going to blow this out of control. And the reality is it's going to get solved because there is no other alternative. This is the only solution, is to solve it. And so it'll get solved and people go on their merry way. But I did want to point this out because this is showing that this is the bond market. We saw the stock market, right? The stock market says all's clear. The bond market is saying, oh my God. And I think this should speak for itself. The bond market is a smart money. Obviously, there's a disconnect. Who knows where it's going to go? But if you had to ask me, I'd say that the market's going to get more volatile and the stock market's going to follow the bond market. I just think, we're still in April and the whole adage of sell in May and go away. Well, May's a week away. So I wouldn't be surprised if the markets take a little breather here and maybe relax and go down a little bit from here. They've kind of had a run up, but I think we're at the top end of the range. We'll probably see a little pullback here. What do you think, Doug?
Yeah, I think there was a lot of people, some really smart people in the room that thought that April was actually going to be a time when we were going to start to see that pullback. And I think that, we're starting to see there's some people that watch different things. And one of the ones that one gentleman watches a lot is lumber, and how lumber disconnects from the dollar, and lumber pricing had been plummeting. And then I can't watch it recently, but it made another change. So there was a lot of thought that April was going to be rough. I think things have been very calm. If you watch the market recently, that's just kind of been bouncing around, not really doing much. And it has some, and that leaves a lot of room to go. I think if you go back to, it leaves a lot of wiggle room for something to break at some point. And considering that we are higher than we were, the natural belief would be that that's going to fall. And if the VIX is as low, whether it's accurate or not as it is, generally, guess what? You know this, Kirk, from history. The VIX spikes after crap hits the fan, right? It's not, it doesn't spike before crap. It's not a leading indicator, right? It's a reactive indicator, which is why, and again, we're not giving investment advice here, but when the VIX, there are people that will say when the VIX is super low, that's the time to bet that problems can occur, right? That we are in a moment of irrational calmness with everything going on. And and after everything has hit the fan and the VIX has spiked significantly into the 20s, maybe 30s or higher, then that's the time to really start to believe that the worst is going to be past us, right? When you're in the eye of when you're in the eye of the storm, you're kind of coming out the other side, but everybody's got their flags up. You talked about the debt fault, or the debt ceiling. Listen, I can't remember what year it was, and we've been through a couple of these debt ceiling discussions with Congress. Seems like there's at least one every year now, or every couple of years. Whenever they hit it, they tend to come up with an agreement at the last minute. But let's not forget, I don't remember again, Kirk, when this was, but if we go back basically, into to the late aughts, there was a debt ceiling battle that became so contested between the two sides, that they were so firmly embedded in their stance, that the U.S. did get a downgrade on its credit rating. Okay. And again, that was something I think that the U.S. was in a better position to absorb than it is now. Because we have used a lot of our options over the last 15 years to keep rates cheap, to pad the markets, to pad real estate, to keep everybody feeling good that there are no problems. But right now, if you go back 10, 15 years ago when this happened, the United States was still very much entrenched as the world power. And there's a lot of people that argue that going back to the Cold War, one of the good things about the Cold War was that by having two superpowers, there was this feeling of some balance, right? We all know that kind of Soviet Union was kind of was around the world, was the one that had the worst reputation. You look at what happened with Afghanistan, and it kind of point fingers, look at how stupid they were in going to Afghanistan. What happened? Well, guess what? We repeated the same thing, 10 to 20 years later. And we got into the same exact financial drain that happened to the Soviet Union, except the difference was this time the Soviet Union was gone. And as us being the only country in the world that is standing on that Mount Sinai, that peak there, the entire world is pointing its fingers at us and wanting to see now there's only one bad guy left, and it's us. Okay. So whether or not they can economically and do this, whether or not they can politically do this, the rest of the world is consistently feeling pressure from our policy, and they don't like it. And so there is an active effort, just like with anybody. Once you're top dog, everybody's trying to pick you off the mountain. There's an active effort around the world to pick us off the mountain. Can they do it is the question. There are more things going on right now to potentially successfully make that happen than we've seen in the last 100 years. All right. So now what happens if we get, when we went into a debt rating downgrade before, we were still fully entrenched as the top dog in the world. There was no way that the rest of the world was really going to be in a position to make decisions economically around us. U.S. treasuries were still considered to be one of the safest places to be. But now, if we have another debt downgrade, I am concerned. I'm not going to say I'm convinced, because there's still an incredible amount of things that the United States has power over. But we're not sitting alone. The new Cold War is us versus a collection of other countries. China, India, Russia. They are working, and now you start to get the the Middle Eastern bloc, and you start to get not the BRICS. What's the oil cartel?
OPEC.
Yeah, thank you. You
OPEC
start to get
plus.
OPEC lining up with them. You have now created the new Cold War. Now, does that mean that the future of the United States has collapsed? Not necessarily, but it certainly means everything's going to be harder economically for the United States if we get back into that world. And we will still be viewed, since that's a collection of companies, as possibly the more evil of those two worlds, which means people, in order to fight the giant, are going, when I say people, countries are going to potentially align with them more and more, just to come back and attack us. And so, and again, what's just like we talk about the stock market, and you spent the last, 15, 20 minutes talking about this, Kirk. The stock market is nothing but a prediction of what they expect the outcome to be, over a period of time. And if it hits it, nothing happens. If it turns out to surprise, whether it's to the positive or the negative, big things happen in the markets. Well, if we get into a situation where the U.S. credit gets downgraded, if we get into a situation where the future makes it much harder for the United States to have economic and world policy and have an effect on that, guess what that means to the United States? It means that what was predicted to be the United States position in the future now gets deemed downgraded. It now means that makes it much, much harder for the United States to be able to take positions. It makes it much, much harder for the United States to make policy decisions that have an effect on a global scale. And that doesn't mean the United States is going anywhere, but it certainly means that that it is subdued financial outcome. And that also, of course, means that some of those things like inflation and interest rate policy and the things that we've been able to just snap our fingers and influence and adjust, they may go away, or they have less impact. And that could make things much, much harder. And potentially never to recover to the peak of where we were again.
So I want to get into a few areas here. We got 20 minutes left. So I'm going to show this chart here, and I'm going to tell you what this chart is. This is San Francisco office vacancies. You might say, wow, that's really crazy. It's gone way up and things are going to implode. Well, yes, you could say since COVID, pretty much vacancies have skyrocketed. But I'm going to zoom back, and I'm using this as an example because I think a lot of people look at a chart and they just get an impression like, oh my God, that's crazy. It was really low and now it's 29. Let me zoom back, and what you'll see is, yeah, it was like 3%. Now it's 29. That's bad. But oh look, in the early 2000s, it was like 18. So I point this out. Yes, it's still high, but it was high in comparison to a really low point, which is, tech euphoria, which is, tech companies all over the place, starting up companies. Everything was great until 2020, and all of a sudden things changed. And they've gotten progressively worse because of the real estate market. But I just wanted to point that out because I think it's a good example of perspective matters. When you're looking at things, your perspective on that chart, when people show you something, can change drastically if you zoom out and look at something else. I also wanted to, as we kind of go through here, let's see, you know what, I'm going to go to different charts because there's some other ones. I also want to go to some different charts here to show, okay, there's some other pieces here I want to get to. One is, let's see, okay, banks. Let's talk about banks. We haven't talked about banks in a while, but I want to show this chart because when people talk about banks, they say, oh, the banks are in terrible shape, or the banks are in great shape, or everything's great, or, there's always some extreme event. But this is a chart. This is 4 different charts. So the upper left is a chart of the big 6 bank index. So these are the top banks. Okay, they sold off in March, and then they've come back sharply. But if you look at the KBE, if you look at community banks, regional banks, if you look at all of these, you're going to see a very different picture. And what this shows is basically that if you're any sort of regional, like banks in general, except for the big six, regional banks, community banks, they haven't done very well. They've done very poorly. Stock price. I mean, this is not earnings. This is stock price, and I'm sure earnings will come about. But while the big banks have come back, and that's in large part because what is basically happening is consumers are fleeing small banks. They're taking their deposits out and putting it in the big banks because they're thinking the big banks are too big to fail. So my money will be safe there. No matter how bad they are, my money will be safe. I think that's kind of silly, and that's actually what happens with bank runs is that people lose confidence in the banks. And so the problem is the big banks are getting all the money, and the little banks are going to start to basically go under because people are pulling their cash out, and they don't have liquidity because it's all invested in treasuries and yada yada yada. So this is a bank run. This is what it looks like, and this is not the underlying fundamentals. It's just the stock price reflective of what people think is going on. So I point this out because these charts are very different, and this is still the same sector, right? And I would argue that not much has changed other than consumer sentiment, which we talked about earlier today. Consumer sentiment has changed, which has caused people to lose faith in the banks. So it's effectively a self-reinforcing policy, or what we call reflexivity, which is something happening. So a thing happening causing more of that thing happening. A bank run, people thinking there's a bank run causes a bank run because people think it's going to happen. So I wanted to point that out. I also wanted to point out another chart, which is gold. Now, you've probably been hearing a lot about gold lately. Well, there's a good reason, because gold is at its all-time highs or close to it. If it's definitely past its cycle highs, but I think it's just above its all-time highs. So here's what's important. It really doesn't matter what it says in US dollars, okay? Because all that says is in comparison to the US dollar, gold is doing well. Well, that could mean that the dollar is going down, or it could mean that the gold is going up. We don't know, right? Because in any transaction, whether it's gold, whether it's real estate, whether it's stocks, it's all in comparison to the dollar, right? You're taking your stack of dollars and you're exchanging it for real estate or gold or stock, right? So if the stock's going up, it could be because the stock's going up, or it could be because the dollar's going down. So one of the two is happening. Now, the thing to know is if you want to know if gold's in the bull market, this is what you look at. I saw this and I had to. I usually do this. I don't put it together like this. I grabbed this from somewhere. I thought it was a good illustration. But basically, you want to look at gold in price of multiple currencies. You want to look at the U.S. dollar, the Australian dollar, Canadian dollar, the yen, the euro, and the pound. Now, if gold is going up in all of those currencies, it's in a bull market. That's what you need to know. It doesn't matter what the dollar is doing. What matters is globally, is gold going up in comparison? Absolutely. You can tell since pretty much for the last, I can't even tell if this is annually or years. Yeah, this is based in years. So there's a bull market in gold. That's what you need to know. And, you might say, well, I don't know if it's going to keep going higher. The whole world thinks it's going higher. Now, maybe temporarily it might drop because if you notice in the upper left, it's hitting a triple top, which if it breaks is very bullish, but temporarily it's probably bearish because it means it has to break through that. So we'll see. If it breaks through it, it'll be very bullish. I think that the trend is definitely up in gold, and if you don't have gold in your portfolio, you're kind of missing out on a big trend that is happening. Don't look at the day-to-day stuff, but if you're looking at a longer-term trend, I think it's hard to miss. So I wanted to point that out, gold being in that trend. This is the central bank purchases of gold, and it's spiking up. And if you notice, pretty much the last 10 years, that central bank purchase of gold, and central banks are basically the Bank of England, the U.S. The Federal Reserve. Each country has their own central bank, and when they're buying gold, that's usually a bullish sign on gold. It means that they want more security. Given what Doug just said about the world's being disenfranchised with the U.S. and the fact that what the U.S. has done to Russia, they all want hard currency. Well, what's hard currency? Gold. Now you could say, well, whatever, it's a barbarous relic, people don't use gold. It doesn't matter what you think. What matters is what everybody else thinks. And does everybody else think gold's a good idea? Then you might want to own gold because it's going up, because people want it, right? And who knows whether it'll be used in the zombie apocalypse. I don't really care. That's not why I own it. I own it because it's an inflation hedge, and it's also something that people are going to desire in a time of uncertainty, which we're heading into. And so gold should continue higher because of that trend. So I just wanted to point that out. I think it's really important. And here's the gold futures, basically gold price in comparison to the U.S. 10-year real yield. And it's just a chart to show correlation. Don't read anything into it. I don't for this, but I just want to kind of point that out. So I want to point out one more thing, and I'm going to let Doug kind of close it up here. This has not been talked about, but you're going to hear it first on the show, and you'll probably hear it in the news after this because people get a lot of their news from us. If you look at what happened with the banks, okay, the banks themselves were a problem. But here's something that wasn't talked a lot about. Since early 2000s, they created these products called structured products. Basically, what structured products are is some sort of concoction that a investment bank creates. So let's say a covered call. We don't talk about them all that much on the show, but covered calls are basically a way to generate extra income on stocks that you own, okay, using options. Very conservative strategy. People love them, especially people in retirement. They love them because they can generate extra income. Now, the investment banks, what they'll do is they'll take a covered call, they'll put a wrapper around it, and they'll say, all right, if you buy GE today and for the next year, you can get, 7% on GE. And if it goes down, well, you own GE. But if it goes up, you make no more than 7. Okay, well, that's interesting, let's say, hypothetically. And you say, hey, I want to buy that thing. Well, what they do is they package it up, they put a QSIP on it, and then they sell it to you and say, oh, you buy this Bank of the World sponsored structured product. Now you're basically buying GE with an option on it. That's what's inside of it. But what you're actually buying is credit risk of that bank. So if this large institution, the Bank of the World, goes under, and you notice Credit Suisse got taken over by UBS, but let's say it was allowed to go bankrupt, hypothetically. All of the Credit Suisse structured products would now be basically worthless because a structured product, you're taking credit risk based on the issuer of that security. Now, I'm not sure that 100% of them do this, but every single one I've seen does this. And so when you're buying these structured products, and they're a big hit, if you have a broker, if you're using a broker, they probably sell you these because they make big commission. They're making 5-7% on these things. So they're going to sell you as much as you can get. Is that a good idea? I don't know. I get interviewed once a week by the newsletter for this industry, and I haven't seen too many that I like. Maybe 1 in 200, 1 in 300 I've seen that I like. Generally, I don't like them. What happens is the institution's trying to get rid of them, so they package them up and sell them to somebody. That's basically what happens. So you're buying garbage. That's why I don't like them, because you're buying somebody else's garbage. So, but that's not the point. You could argue whether they're good or bad idea. I don't know. But the important thing is to understand there's credit risk involved in these that is not being accounted for. People don't understand that they're taking credit risk when they buy these things. Yes, the underlying itself is fine, right? Let's say it's stable, but that's not what you're buying. You're buying a security backed by the institution. Well, if the institution goes under, then it's not backed by anything, which means that you're basically taking risk. You have to stand in line with the creditors. This is a huge problem. Now, I know the financial system is doing a lot to secure these big institutions, so you'll probably be okay because they're probably too big to fail. But I point it out because no one else is pointing it out. And if there's a big implosion in the financial system, these potentially could be a problem. And if you're not aware of the risk, you could be putting your portfolio at risk without even knowing it. So there's a lot of reasons I don't like structured products. I understand them well. I think they're interesting, but I would not be touching these things in this environment. If the environment's safe and there's no credit risk and there's no institutions going bankrupt, they're probably okay. But in this environment, it's just more risk you're taking that you don't need to take. why buy the structured product when you can go out and do the exact same thing yourself without taking the credit risk of that financial institution? This could be the next big implosion that happens that no one is talking about. I haven't heard a single person talk about it, and I talk to a lot of smart people. But this is a big problem, and it could potentially, any sort of bank failure could trigger failure with these other products and could cause a big cascade because there's a ton of money tied up in these things. So, Doug, I want to. I got a few more quotes, but let's maybe you can kind of sign off and give us your final thoughts, and we can wrap it up here.
Yeah, you want me to sign off first and then give me your thoughts, or give you the thoughts?
Whatever
Or,
you need.
No,
Whatever,
I'm
yeah,
just
whatever
teasing.
you want to do.
No, I meant I could leave. No, I'm just kidding you. So I want to go back to really quickly what you said about gold. I think that really important take there is gold can be an inflation hedge. We never like to say can be an inflation hedge. And I also do think that there is a lot to be learned. Like gold is heavily correlated because it's priced in dollars. Gold is heavily correlated to how the dollar's doing. And I think you mentioned that, but I wanted to wait on that again because sometimes, gold will appreciate even if it's really not been a demand issue, right? If it's just because the dollar is falling, you will find that the value of gold will increase. Why? Because it's going to take more dollars to buy that same ounce of gold. And if the dollar is increasing and getting stronger, you'll see the price of gold go down potentially because of that. Why? Because it takes less dollars to buy it. So I think that's very, very important to note. We got a question here. Even governments are necessarily too big to fail. So I'm not sure I'd pick up a structured product. We already are carrying bank risk by being a depositor. Why would I take more of their risk with structured products? I want to come back and talk about that piece because I actually do have quite a bit of familiarity with structured products. First of all, it's not always commission based. I know there's a lot of them out there that can be held with inside of advisory accounts. So it's not always about the commission. I think I wanted to make a note on that. And the commissions I've seen on them aren't that high. Now, I don't do a lot of them myself, but I know people that do very successful. But here's one thing I would note about it. It's just like anything else. You have something that's going to be held and backed by the bank. Know who's holding your product. Okay. And it goes back to what we've talked about in previous conversations, the banks, and going back to a lot of the changes in regulation. Now you got the investment banks and they got muddied because now the investment banks and the commercial banks could start overlapping and own each other. And I think that's where that real risk has escalated because again, you could have the investment side of it backing the structured notes, the zero coupons, doing the options trading on the back end to secure that money. But if it's in the same bank that is heavily leveraged and invested poorly against their deposit accounts because they got rid of fractional banking, they got rid of any reserve requirements, you're going to have your investment put at risk by the overall decision-making of the banks in other areas. And that to me, again, is that commingling, that muddying of what is the core purpose of this bank. Now, there are other institutions out there like Fidelity, First Trust, and other like brokerage and mutual fund and investment related companies that also do these products. And again, many of them may be in much more solid financial position to back them because they don't necessarily have the same leverage going on and the deposit risk that's going on with other banks. This is the problem, though, with any investment, Kirk, and you agree with me on this, is that you got to know what your money is going into. You got to understand who's behind it. You got to understand the liquidity. The other thing, too, is that these banks will come out and they'll price these things at a certain level, meaning that, there may be a certain return that is gotten by the note, and they're going to give you a piece of that return and how they write those options. And again, sometimes with more weighting, you can actually get those notes customized in ways in which the return on the risk of what risk is there, and there is a risk, is going to be much more favorable in your position. But unfortunately, a lot of the retail ones that are out there that are sold, they are sold and structured in a way that is, while favorable potentially to you as long as it's solvent, can be more favorable to the bank because of the limited spread of what you get based on what they're doing on the back end. So there's a lot that goes into these. They're complex. We've actually done and looked at some of the documentation we provided some clients, that have been, that have been out there on, trying to learn. They've asked me about these things. Like, here's some documentation. When we start getting into the risks and all of the back end and legalese on it, it's a wonder why anybody would get involved with them, because there is a lot that can go wrong and they can be structured in any number of different ways. But this is also why the last thing I'll leave you is, if you are going to use anything like that, you don't use it as an end all be all. 10% of your portfolio going into it might be the same thing you might do as 10% into other speculative risk. And therefore, if something goes wrong, it's not going to take your entire ship down with it. So again, this just goes back to fundamental investing philosophy. It's just one more piece you could be putting your money, know the risks that go along with it. All right. Well, Kirk, thanks for having me again. I know we're right up there and against the hour. So I'm just going to say, guess what? Speaking of risk, how about the risk of paying $100,000 to $200,000 to $300,000 and getting nothing in return for that? Raise your hand if that's something that you would ever really want to put your money into. Well, unfortunately, this is what people do every day with college, right? They spend $100,000, $200,000, $300,000 for their child to go to school. And at the end of the day, it is astronomical, the number of families that either do this by taking on debt, or their child graduates into a career that they don't like or doesn't fit them, or let's just say they don't jump into a career that even fit the major they were going for because they can't get a job. How many people roll into sales? It's like, well, I had a degree in philosophy. So here's the thing, do it right. Make sure you're going to get a return on investment on college. Everybody pays a different price, but the people that know and have the knowledge to even the game are the ones that are going to get the best outcome on that. If you want to learn a little bit, go to ProCollegePlanners.com, ProCollegePlanners.com right now. Download our free numbers checklist. If you don't have that information, how can you even begin to go through this complex process? ProCollegePlanners.com. Download our free checklist right now.
Great. Well, Doug, thanks again for coming on the show and sharing your wisdom with us. I'm going to leave the listeners with two final thoughts here that I had, and I thought one was interesting. So we had Rob Arnott from Research Affiliates on the show in the past. It was a great interview. One of my favorites. We're probably going to have him on again. It actually just came out with a prediction, which, you know what I think about predictions, by the way, because we love those on the show because they're always accurate. But he's a smart guy, and a lot of institutions look to his firm for their own research. So that shows you kind of what the street thinks about him as well. What his firm predicts is inflation will dip to 2.9 by mid-year. Wow, that's really low, and it's not zero, but it's a lot lower than I think most people think.
Sell your gold right now, Kirk. Why are you in it? What a terrible holding! We're going to have no inflation.
I know, no inflation. However, by mid-year, and then surging back to 5.7 by year end. This also reflects a lot of things we've been talking about in the show. I think it was called the bullwhip effect, Doug. It's people are starting to listen to us, I think, and actually, we're like years ahead of everyone else, I think, with all this stuff. But and I don't mean to. I'm a pretty humble guy. I don't mean to toot my own horn, but it's always nice to when the street finally recognizes stuff that we've been saying for 6 to 12 months. So I just wanted to kind of point that out because I thought it was a great quote, and I'll probably have Rob back on the show to come talk about it because I think it's probably going to be reflective of things we've talking about, and he has probably a lot more detail that he can provide because he's such a smart guy. And I also wanted to point this out because we're in a period of time with the markets where there's a lot of volatility and there's not a lot of clear trends. The buy and hold crowd is going to be hurting for the next 5 to 10 years. Not because what they're doing isn't right, but because the market environment is going to be different and is going to penalize people for the buy and hold kind of mentality. So I want to point this quote out. It was by Barry Bannister. And the quote is, "The stock market will find your own weakest personal trait and then do everything in its power to use it against you." So basically, the stock market is a crucible that you find yourself in, that you have to that you're basically challenging your own interpersonal self if you want to be successful in the markets. People like Warren Buffett moved to Omaha to stay away from all the chatter of Wall Street, and he just wanted to do his own thing. He probably knew he couldn't deal with it as well, so he moved away from it, and that was his solution. But the point is, we all have our own weaknesses personally, like psychologically, whatever. We all have our own flaws. We're all flawed human beings. And we just need to understand the stock market is going to take that and amplify it. That is a truth. And that's why people use computers to trade. and to manage money, because it takes the emotion out of it, and emotions, albeit are good things for people, they're really bad for investing.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.